change is happening in America's job market. Over 25 states are now seeing unemployment quietly climb, the most widespread rise since 2020. The national jobless rate has jumped from 3.4% to 4.3%, wiping out millions of paychecks in just months. Yet the government insists the economy is stable. Consumer debt has exploded past $1.14 trillion. Wages are stagnating, and job openings are vanishing faster than any time since the Great Recession. Economists call it a soft landing. But if that's true, why are so many Americans falling through the cracks? Because this isn't a slowdown, it's a silent collapse. The cracks are now widening. Across the country, job boards once flooded with listings are drying up. Over 8.2 million Americans are now officially unemployed. But that's only half the story. Another 5.4 million have simply stopped looking.
Ryan Reynolds here for Mint Mobile. It turns out one of the fastest growing segments of people signing up for Mint are people over the age of 55.
The government calls them discouraged workers, as if their struggle can be erased by changing the label. These aren't just numbers. These are people who can't find a full-time paycheck even after sending out hundreds of applications. In states like Ohio, Nevada, and Michigan, layoffs in manufacturing and logistics have surged by 27% since early 2024. Meanwhile, major retailers are quietly cutting hours to avoid paying benefits. A warehouse worker once earning $22 an hour now juggles two part-time gigs at $15 each, with no health insurance and no overtime. The illusion of low unemployment hides a brutal reality: a workforce running on exhaustion. Behind every percentage point lies a collapse of stability. Companies are replacing humans with automation, cutting costs by $30 billion annually. Corporations report record productivity, but workers see none of it. Real wages, when adjusted for inflation, are down 2.3% compared to last year. Food prices have risen by 19% since 2021, and the average rent has crossed $2,100 a month. For millions, every grocery trip feels like a paycheck test. What makes this collapse so strange is how controlled it seems. There's no single event, no crash, no panic, no headlines shouting recession. Just a quiet suffocation. People are still working but living worse. Businesses are still hiring but paying less. The middle class is slowly evaporating, one layoff, one reduced shift, one rent hike at a time. America's job market isn't collapsing overnight. It's bleeding silently, masked by optimistic press releases and delayed statistics. The economy isn't shrinking. The American dream is. And as the gap between official data and lived reality grows wider, the question becomes chillingly clear. How long before this illusion finally breaks? What makes this collapse so unsettling is not only the pain it's causing, but the silence surrounding it. According to the National Bureau of Economic Research, the first signal of a recession is a rise in unemployment. By that measure, history is already repeating itself. Since the 1960s, every time unemployment has risen by more than 0.8%, a recession has followed. Today, that exact pattern is unfolding, yet officials insist we're safe. The economy is still reporting 2.1% GDP growth, industrial production appears steady, and corporate profits on paper remain positive. But beneath that calm surface, every foundational indicator of real activity is faltering. Factory orders have dropped 4.6% in the last quarter. Small business optimism has plunged to its lowest point since 2010. And new housing starts are down 17% year over year. Even the University of Michigan's Consumer Sentiment Index, a reliable pulse of household anxiety, is hovering near levels last seen during the 2008 crisis. This isn't just data, it's contradiction turned into policy. The government measures growth while ignoring what that growth actually means. GDP can rise while life declines, when the economy expands through debt, not production. And that's exactly what's happening now. National debt has ballooned past $38 trillion, up $1 trillion every 100 days, the fastest pace in American history. The illusion of expansion is being financed, not earned. The danger of this hidden downturn is that it doesn't announce itself. There's no market crash or panic headline, just a slow distortion of normal. The system is still moving but directionless. What we're witnessing isn't a standard business cycle, it's a structural fatigue. Jobs are vanishing, prices are rising, and productivity gains are built on borrowed time. The data doesn't lie, but the interpretation does, and that's why this crisis feels invisible. The numbers look stable because they're measured in dollars, not lives. What's breaking isn't the economy itself, it's the foundation holding it together. The silent breakdown inside the US is no longer isolated. The same economic tremors are echoing across the developed world, forming a synchronized pattern of decline that economists refuse to call a crisis. In Canada, unemployment has surged to 7.1%, the highest since 2016. Germany's rate climbed to 6.3%, and Britain now faces 4.7%, paired with a staggering £280 billion in household debt. These aren't random fluctuations. They mark the spread of a global labor contraction driven by automation, corporate downsizing, and collapsing consumer demand. This is the first time in modern history that nearly all major Western economies are tightening simultaneously while their populations face declining living standards. The combined GDP growth of the G7 nations has fallen below 1.2%, the weakest since 2009. Industrial output in Europe dropped 3.4% this quarter, and export volumes in North America are shrinking despite supposedly strong markets. Every economic heartbeat is slowing, yet central banks maintain the illusion of control through interest rate manipulation and forward guidance statements that sound more like therapy than policy. Behind every chart is the same unsettling reality. Productivity is stalling while debt is exploding. In Japan, public debt now exceeds 260% of GDP. In France, social spending consumes over 31% of national output, the highest in the world. The Western system, once built on expansion, is now trapped in maintenance mode. It's no longer about growth. It's about survival through delay. The strange uniformity of this slowdown suggests one uncomfortable truth. The world economy has become synchronized in fragility. What used to protect nations, geographic distance, sectoral diversity, independent monetary policy, no longer works in a globalized web of dependence. When one market bleeds, the others follow instantly. The collapse isn't coming from a single corner. It's emerging everywhere at once, in slow motion. And as these cracks widen internationally, the illusion of recovery back home becomes even harder to defend. The question is no longer if the system will break, it's which domino will fall first. While global economies drift toward stagnation, financial markets are broadcasting the opposite message: record highs, glowing optimism, and endless confidence. But beneath those green tickers lies a paradox that defines this entire collapse. The market is thriving because the real economy is breaking. In early 2025, the average stock fell 35% during a brief bear cycle. Yet within months, indexes rebounded as if nothing happened. That rebound wasn't fueled by growth. It was powered by expectation. Trillions of dollars in speculative capital are now circulating in a market detached from labor, production, and value. The U.S. stock market has gained over $11 trillion in capitalization since mid-2024, while total worker compensation has barely moved, rising only 1.3% after inflation. Corporations are cutting staff but boosting share buybacks, nearly $1.1 trillion worth in 2025 alone, the second largest figure in history. Wall Street celebrates efficiency. Main Street lives the cost of it. The economy has become a reflection of concentrated wealth, not collective prosperity. This distortion creates a dangerous illusion. Investors interpret it as a new bull market, but it's a mirage sustained by liquidity, not fundamentals. Corporate earnings growth has slowed to 0.6%, and household purchasing power is eroding. The market's strength is the byproduct of monetary relief, not productivity. When optimism replaces production as a growth engine, collapse becomes a matter of timing, not possibility. The emotional dissonance this creates is enormous. A society where stocks rise while savings fall is one on the edge of psychological fracture. The public sees record valuations while facing record insecurity. Confidence indexes climb because algorithms trade optimism faster than humans can feel despair. The illusion will hold until liquidity dries, until one policy misstep snaps the thread. And when it does, the same cycle that lifted hope will magnify collapse. The market isn't predicting the future anymore, it's borrowing it. The illusion of market strength cannot exist without one architect, the Federal Reserve. Every decision it makes now sits at the center of this fragile balance. Since mid-2024, the Fed has quietly lowered rates from 5.5% to 4.25%, signaling measured easing. But unlike past crises, this isn't rescue, it's restraint. The Fed is trying to calm inflation without igniting collapse, a mission no central bank in modern history has achieved for long. The US inflation rate still hovers near 3.6%, well above the 2% target. Shelter costs rose another 6.2%, energy rebounded by 9%, and core food prices remain 18% higher than pre-pandemic averages. In a healthy recovery, falling rates should stimulate hiring and lending. Instead, banks are holding record cash reserves, over $3.4 trillion, afraid to lend into uncertainty. The Fed's calm isn't confidence, it's paralysis. This controlled moderation is what makes the situation so dangerous. In 2008, rate cuts were a panic response to systemic failure. In 2020, they were emergency life support for a frozen economy. Today, they're a slow drip into an already dehydrated system. Each reduction keeps asset prices inflated while the real economy gasps for liquidity. The Fed is stabilizing the illusion, not the foundation. Every signal from Washington insists this is a soft landing, yet every data point suggests turbulence ahead. Corporate defaults are up 41% year over year. Commercial real estate loans worth $1.1 trillion are nearing maturity, and Treasury interest payments have surpassed $1 trillion annually for the first time in U.S. history. The central bank is trapped between credibility and chaos, raise rates and risk mass default, or cut further and risk inflation reigniting. The result is an unprecedented stalemate. Monetary policy has lost its power to correct. What we're witnessing is not confidence. It's exhaustion disguised as stability. And the longer this balance is maintained, the more violent the correction will be when it finally breaks. Beneath the calm reports of GDP growth and stable inflation lies the most dangerous shift yet: the internal erosion of financial resilience. America's household balance sheet, once the core of its economic strength, is breaking down faster than any official data admits. Consumer debt has exploded past $17.6 trillion, with credit card balances alone exceeding $1.14 trillion, the highest in history. Interest rates on those cards have surpassed 24%, trapping millions in compounding debt. The average American now spends 46% of income just servicing obligations, rent, loans, and utilities, leaving almost nothing for savings or mobility. This erosion isn't visible in stock indexes or GDP charts because it's not measured in profit. It's measured in pressure.
Listen, paying $14.99 a month for a streaming app and $9.99 a month for a music app and $12.99 for
Personal savings have collapsed to 3.4%, the lowest level since 2005, while emergency funds are drying up. Over 60% of households report they couldn't cover a $400 expense without borrowing. The financial system calls this consumer resilience. In truth, it's slow suffocation. Corporate leverage tells a similar story. U.S. companies now owe $13.7 trillion in debt, much of it borrowed when interest rates were near zero. As those loans mature, refinancing at today's rates will erase profit margins overnight. The commercial real estate sector alone faces $2.2 trillion in upcoming debt resets through 2027, threatening a wave of defaults that could ripple through pension funds and regional banks. This isn't the chaos of a sudden crash. it's the exhaustion of capacity. Every institution, from households to corporations to the government itself, is running out of margin for error. There's no buffer left between normal and collapse. The frightening part is how quiet it feels. The metrics look orderly, yet the structure is hollow. The economy has not failed. It has thinned. The next shock, whether financial, political, or environmental, won't need to destroy the system. It will only need to touch it, and the entire illusion could shatter in an instant. What follows financial exhaustion is psychological collapse. Economies don't break the moment money runs out. They fracture when confidence does. Across the United States, confidence is evaporating at the fastest pace since 2008. The University of Michigan Consumer Sentiment Index has plunged to 61, a level typically seen only during deep recessions. Yet GDP still claims growth. The contradiction is emotional, not statistical. People no longer believe in the recovery narrative. This disbelief is visible everywhere. Two-thirds of workers now fear job loss within the next 12 months. Over 58% say their income hasn't kept up with inflation for 3 consecutive years. The result is an invisible depression, not of markets, but of morale. The American worker isn't striking, not rebelling, just disengaging. Productivity per employee has stagnated despite longer working hours. Quiet quitting isn't rebellion anymore, it's surrender. When an economy enters this stage, monetary tools lose influence. Rate cuts can't restore optimism. Stimulus checks can't rebuild trust. The nation's economic health becomes psychological, and right now, that health is collapsing. In surveys, 72% of Americans believe the country is on the wrong track. Consumer spending patterns confirm it. Discretionary purchases are down 11%, luxury sales down 17%, but payday loan usage has surged 22% year over year. It's a transition from aspiration to survival. The danger of this unseen recession is that it leaves no visible wreckage, no market crash, no housing bubble bursting. It unfolds quietly inside households, slowly dismantling ambition, creativity, and social cohesion. When belief in progress dies, so does the cycle of recovery. The economy hasn't stopped functioning. It has stopped inspiring. What's breaking isn't consumption or production. It's confidence itself. And once a society loses faith in the idea that hard work leads somewhere, no amount of policy, stimulus, or optimism can bring that belief back. The numbers may still look alive, but the spirit that sustains them is already gone. Every collapse begins quietly, then unfolds all at once. The American economy now stands at that silent edge, where numbers still look stable, but underlying momentum has stopped. The yield curve has remained inverted for over 16 consecutive months, the longest stretch since the early 1980s, a signal that has preceded every U.S. recession in modern history. Corporate bankruptcies have already surged 58% year over year, and regional banks are reporting delinquency rates unseen since 2012. Yet policymakers describe this moment as resilient. The language of reassurance has replaced the language of reality. Pressure points are multiplying across the system. The commercial real estate sector faces over $900 billion in debt maturing within the next 18 months, much of it tied to half-empty office towers and downgraded collateral. Consumer defaults on auto loans are up 42%, and credit card delinquencies have climbed to 7.8%, the highest in over a decade. Behind each number lies a simple truth. The margin of stability is gone. The Federal Reserve cannot tighten further without triggering systemic distress, nor can it ease too fast without reigniting inflation. The Treasury cannot keep borrowing at this pace without undermining confidence in its own currency. The corporate sector cannot refinance without accepting massive losses. Every lever that once controlled the cycle now leads to deeper imbalance. The system is boxed in by its own contradictions. The emotional climate mirrors this deadlock. People are still spending, but without optimism. Investors are still buying, but without conviction. Governments are still promising, but without credibility. Economies don't implode only from debt. They implode from fatigue. This is that moment. The statistics still move upward, but the direction has lost meaning. The market celebrates expansion while institutions quietly prepare for contraction. What happens next will not be a crash in price charts. It will be a collapse in faith. The world's largest economy is no longer growing. It's stalling in slow motion, one fragile illusion away from breaking completely. And when that illusion shatters, it won't just take markets down, it will take trust itself with it.
Do not pay your car insurance bill. I repeat, do not pay your bill yet. So I found this website and look at the difference.
Well, last night, Donald Trump went from being a lame duck to being a humiliated duck.